Okay, welcome to this online seminar. Kia ora, ngā mihi nui ki a koutou, ko Barry Coates-aho, ko rangatahi ki te Putea Whai Whakaaro. I'm CEO of Mindful Money. Nā mai, haere mai ki te hui mariko. Welcome to this online seminar. Mindful Money is a charity aiming to make investment a force for good. In this series on investing for positive impact, we're covering different aspects of impact investing, which for those unfamiliar is really investing for social and environmental good. This is a rapidly expanding area of investment worldwide from a relatively small base. There's interest and enthusiasm about the potential to not only earn a financial return, but also deliver a positive return for people and our planet. Last week in our opening seminar, we talked about the foundations for impact investing in New Zealand. Tonight, we're talking about the pioneer funds that have been established, and we're going to be finding out more about what they're doing, how and why. So, before we start, let me just tell you a little bit about how it works. You're muted, I'm sorry to be authoritarian about this, but you can put comments into or questions into the Zoom chat at any time. And for those on Facebook Live, if we make the connection, and apologies for that, you can put comments into the comments box. And you can do that as we go along, and then after about 20 minutes of discussion, we'll talk through the questions, have a further discussion. We'll finish by just after 7:45. We're starting a little bit late, so we might finish a bit after that. So without further ado, let me warmly welcome our panelists, and I'll introduce them one by one, and then they can kind of introduce their fund and a little bit about what the fund does. So let's kick off with Roy. Roy Thompson is founder of the Impact Enterprise Fund. Through his role as managing director of New Ground Capital, and they co-manage the fund alongside Akina Foundation and Impact Ventures. And a little known piece of relevant information, in his spare time, Roy and his wife manage their conservation reserve, Mamaku Point on Stewart Island. Roy, we're really jealous, so why don't you lead us off? We need to unmute Roy, please. Karen. And let me see.
Thanks, Barry. Sorry about that, and kia ora, everybody. Yeah, just a very quick background on the roots of the Impact Enterprise Fund, which go back really to 2014, when New Ground Capital and Akina Foundation started working together on the challenge of how we could raise a pool of equity capital for social enterprises, which at that time were struggling to access any equity. There were a few debt options around, a little bit of grant and government funding, but really no equity capital at that time. So after a couple of years of talk and development, we launched a fund together with Impact Ventures, so a collaborative effort. We wanted to start off reasonably modestly. We were hoping to raise a minimum of 10 million. In the end, we raised 8.7, but we wanted to keep the fund relatively small anyway, because being the first fund of its kind in the country, we wanted to make sure that we could safely deploy whatever capital commitments we took in. So we had our first close in November 2018. We've subsequently made 5 investments for a total of 2.5 million out of the 8.7. We've got another 750,000 committed, and we're about halfway through our investment period. So we're very happy with the 5 portfolio companies that we have in there at the moment. We take minority positions, work closely with the companies. On the impact side, we're looking for impact outcomes that are meaningful, measurable and scalable, which might sound easy, but certainly isn't, as we've discovered. And we have a target return on the fund of 15%.
Cool. Thank you very much, Roy. That's a great introduction. Let's move on to Purpose Capital. Bill Murphy is founder and CEO of Purpose Capital. He's helped establish angel investing in New Zealand and is the founder of the Enterprise Angels Network. Since its inception, Enterprise Angels has provided more than 40 million in equity capital to New Zealand's early stage companies. So warm welcome, Bill.
Thank you, Barry. Good evening, everybody. To talk about the what Purpose Capital is, you'll pardon me, I have to sort of step back to the origins or the underpinnings of it. So my own personal conviction is that in order for us to drive the change that's so needed in the world today, particularly given the climate crisis, we have to do things differently, and we're only going to be able to do things differently if we ourselves evolve as human beings, raise our consciousness and take a different approach. Otherwise, we'll simply be using the same old tools and the same old thinking to deal with the problems in the same way, sort of the opposite side of the same coin. So that's an important underpinning philosophical point for our work, our impact work. Maybe the next level of that is, like most of the people probably on the call tonight, my background is finance, accounting, commercial, and impact. And I was just so incredibly excited at the potential, at the opportunity to use that skill set to drive social and environmental change, and to have the opportunity to be able to attract capital to that, give people confidence that we can invest in driving social and environmental change, and we can get their capital back, and we can get a return on their capital. So I was and remain very, very enthusiastic about that, and feel very, very fortunate to be in a position to be able to do this work. And maybe lastly, Purpose Capital itself. Purpose Capital had its first close December 31st, so just under a year ago. We are currently a $21 million fund. We invest, we're not sector specific, because sort of the way Roy and his team, the thinking they did about their fund, we similarly had to look at the fact that we're very, very early in the impact journey in New Zealand. And so we didn't want to restrict ourselves to a specific sector. But we are not an early stage investment fund. We will invest via debt and equity. And we tend to be seeing a lot of projects coming out of the primary industry sectors, which is a place that we're very comfortable, where we can drive environmental change and social change. And I can talk about some of those examples. We've made one investment to date that was into Whakatoa mussels, which again, I can talk about later on.
Cool, thank you very much, Bill. And we'll come back to some of those issues in further discussion. It's a really, really great starting point. Introducing for the fund Tipunahapari, Simba Marakera is Executive Director for Investment Solutions at Brightlight Group in Sydney. Simba previously managed Christian Super's impact investment portfolios, and he's also co-founder of Ignition Impact, an angel network that invests in African small and medium-sized enterprises. So a warm welcome to you, Simba.
Thank you, Barry. Good to be here. And hi, everyone. Really appreciate the opportunity. In terms of, I guess, Brightlight as a group, we are solely focused on investing for impact, whether it's environmental or social. And I guess that's our reason for being. And Tipunahapari Infrastructure Fund is an example of, I guess, some of the products we're putting to market. And, you know, Tipunahapari is focused on community infrastructure, in particular, you know, empowering communities that are traditionally underserved or unsaved in terms of essential goods and services. So talking about health, education, etc. And so we align, I guess, how we invest along those with the New Zealand Living Standard Framework, which kind of, I guess, gives us a sense in terms of where the need is. And from our research, it's largely ends up being in kind of small town communities and regional New Zealand, where it's been lagging behind in terms of community infrastructure investing. And I guess the next point to make there is that we focus on closing the funding gap. That with a lot of the projects we see, they've got some grant funding, as Roy mentioned earlier, that there's quite a bit of grant funding out there. There's quite some access to bank funding, but there's always some funding gap that's there that requires a little bit more innovation and flexibility in terms of how we do that. So that's what we focus on closing that funding gap. And so as a result, we have a fund that's focused on, that's income oriented for investors that are looking for an impact. So we've got a cash plus 3 to 4% return target, again, in line with a defensive and income oriented fund. And because we underwrite our investments based on long-term cash flows that are secured by kind of predictable revenue. And so we can talk about, specific sectors around housing, healthcare, education, etc., that we focus on, and some example projects there. But in a nutshell, that's the fund, and that's, I guess, how we've aimed to complement what's already there in the market, and so that we continue to build the market together with others in the market.
Cool. Thank you very much, Simba. That's great. And finally, introducing Rowan McMahon. Rowan's a principal at Wallaby Consulting, and I didn't realize some other things about him until I looked up his LinkedIn profile. He's been a member of the Ministerial Advisory Group on Digital Inclusion in the Digital Economy, head of strategy at Crown Fibre Holdings, and an executive of Telstra. He's also chair of the charity Lifewise. So welcome, Ron.
Thank you very much, Barry. Tēnā koutou katoa. Thank you very much for the opportunity to speak with you all tonight, and to speak with a bunch of luminaries who've come before me. I'm working on a really interesting fund concept, which is the Climate VC Fund. And I think it's something that could really augment and build upon some of the good work that Bill and Roy and Simba have been talking about. I'll talk about the reason for it before I talk more about what it is. The reason for a specific focus on climate in the impact space is because climate change is, as we probably on this call would mostly know and appreciate, so large and so pressing. We think that there is a whole range of things that need to happen in order for us to get anywhere near the sorts of 1.5 degree futures that we would aspire to. And part of that is a big old funding gap, some of which is on the debt side, some of which is on the equity side. We've looked at working with a team of people who share some of my philosophical views on the topic. We've sort of come to the view that we have to be not on the balcony, but on the dance floor on this topic, and that where some of my background as a technologist could be best used is in the venture capital space. So further to think about what the fund actually could be, we've been developing the idea of as I say, an early stage technology-oriented VC fund that is for profit. So it is something that is going to bring in funding that wants to make money, but also clearly has an impact thesis that is around measurable, reported, and sizable, hopefully, emissions reductions, and can actually benchmark those against international projects, and can help us within New Zealand to commercialise technologies that can really help us on the emissions reduction journey and pathway. Like Bill's Purpose Capital, we're not sector focused, we're emissions focused. So we want to think whether it's transport or it's energy or it's agri or it's waste, we don't mind. We just want to find ways to bring new technologies to market that will help us along that journey. And we think that that's pretty big, hairy goal, and I'm really looking forward to talking with you all more about it. Thank you.
Sure. So it strikes me that we have four very different funds that we're talking about tonight. And they vary across different stages: early versus mature, debt equity, community-oriented versus more business-oriented, infrastructure versus technology versus truly multi-sectoral, and different return expectations. So it's great to see this degree of diversity into kind of our impact ecosystem. But let's tease out some of these particular approaches that you're using. Roy, can I come to you with a question? You guys are obviously in quite a challenging kind of area where you're looking for relatively high returns, and you I think have seen quite a few companies along the way. Do you see that there's a kind of pipeline problem, an investment readiness problem from the New Zealand sector, where you're not actually seeing the kind of impact investment opportunities that maybe you expected?
Yeah, good question, Barry. And I wouldn't necessarily say that was the case, actually. I think, you know, we thought long and hard about our return target before we settled on 15%. And it's perhaps helpful just to explain some of the thinking behind why we landed on that figure. You know, on the one hand, being the first structured impact fund in the market, we wanted to avoid creating a precedent in people's minds in the New Zealand investment community that an impact fund has to be highly concessionary.
Concessionary, yeah.
So that was something that weighed heavily in our minds on the one hand, and on the other hand, being sort of the first fund, although we were small, or actually partly because we were wanting to be small, we couldn't really use the excuse that you know, we were going to struggle to find deals. So, you know, we felt we had to back ourselves and set a challenging, but what we felt was a realistic target. We have looked at over 400 different enterprises at this stage. Some of them very briefly at a very high level, some of them obviously much more in depth. I wouldn't say that was out of the ordinary for a fund of our kind. We've made 5 investments. We've got another 4 or 5 that we're progressing due diligence on at the moment. But of course, any sort of early stage fund is a challenging activity. It's even more challenging when you add on an additional layer, being the impact screen. And, you know, we probably rule out as many potential opportunities because they fail our impact test as we do because they've, and particularly around the meaningful test, you know. Meaningful is obviously highly subjective, but we spend a lot of time thinking around what is meaningful. Is it something that's sort of nice, but perhaps a little bit of a middle class nice to have? Or is it actually changing, you know, turning the dial in some meaningful way? Is it truly measurable, and is it actually scalable? Those are 3 very important tests that each one of our companies has to pass.
Cool. Great. Thank you. That's very clear. Bill, kind of turning to you with perhaps a more mature venture focus, more on agriculture and processing and natural resources. How do you see the challenges facing Purpose Capital? I mean, and as you say, you've made 1 investment so far, but and you're just starting. But how do you see the challenges ahead?
I guess first off, I have to chuckle a little bit, being the guy who spent 12, 13 years in the early stage commercial space, helping to build that in New Zealand, along with other people, of course. for me to launch an impact fund and have it not be an early stage investment fund is kind of ironic in a way. But the early stage space is incredibly important. But I didn't feel that I would be able to raise significant amounts of money if I was presenting a fund with that level of risk in it. So I chose to not. Our fund is a 6% return net of fees, 6% IRR net of fees. Therefore, a big challenge for us is being able to find projects that have the necessary risk, lower risk. We certainly can't be looking at early stage risk. Having said that, in the impact space, everything's new. And so a lot of the projects that we're looking at are new projects, but there's elements to those projects that are de-risking elements, and we look to make sure that those are introduced into it. So for instance, it could be someone who wants to build an 8.9 hectare glass house, who's had 40 years experience growing tomatoes in controlled environments. So huge experience all around the world. That's the kind of thing that takes risk away from a startup project like that, though there's still plenty of other risk in it. So yeah, that was the thinking that we took. I felt I wouldn't be able to attract significant capital if we were going really early. Yeah.
Interesting. Yeah. And as you say, a bit of an irony to spend a fair bit of your life on early stage financing. Simba, can I ask you? So Tipunahapari is taking a different approach, and I guess the issue of more of a blended finance approach where there might be some grant elements to a community-based infrastructure project, for example, gives you a different focus. We last week we had a really interesting discussion with Rangamarie Price, who's been involved in work in Taitakarau, and that was really interesting because she said, from a community perspective, impact investing is just investing. That actually, if you take it down to the community level, then actually almost by definition, a lot of the investment opportunities will provide those social and environmental benefits, particularly from a Māori perspective. So can you talk a little bit about how that, how you see that working with Tipunahapari and recognizing that also you're a very new fund?
Yeah, that's right. I mean, I think we also had to do a bit more thinking and sausaging around what is the nature of the product we want to bring to market. And so we did a lot of kind of community consultation to identify, I guess, where we can add value. We recognized that there were already players in the market, and therefore the last thing we wanted to do was to kind of replicate what's already being done, but we wanted to complement that. And so we landed on infrastructure, largely because when we were talking to communities, largely, Pacifica communities or Maori communities and etc., they were telling us that, we need space for our kids to have after school programs, or we need a healthcare facility that understands how our community, etc. And so that was a kind of a theme that was coming through our conversations. And so that tilted us towards the infrastructure and creating, infrastructure that facilitates that and empowers those communities to realize the potential they already have. And so once we realized that infrastructure is where it needs to be, the second thing was, where do we play in the capital structure? And we again recognized that there were a lot of kind of grant funding that was there. There was some access to bank funding. And I think from our perspective, we wanted to keep the ownership of that infrastructure in the community. So which means that we didn't want to have a, equity exposure, basically, just because we wanted the ownership to remain in the community, and we provide debt funding on top of that. So that led us to having a debt approach to this. And again, it also allows us to, but we've kept in the fund the ability to get some equity if it allows us we're focusing on plugging the funding gap. So we've allowed ourselves in the fund to take equity stake if it's needed to get the deal done. And so we've done that. And I guess from our perspective, our approach to this is that when it comes to impact investing, and in particular, where you are providing essential goods and services to underserved or unsaved communities, it's hard to push the needle on increasing the revenues up, or ratcheting the revenues up, right? Because there's only so much someone can pay for early childhood education or for housing, etc. So really, what you can do is to reduce the risk rather than kind of increase the return to meet where the risk level is. You can keep the returns modest and reduce the risk as much as you can. And hence, that's part of the reason for us to remain at the debt level, because that's lower risk. But also, we've also have this kind of blended finance structure, again, to reduce risk for investors. So that, investors come in and they've got a downside protection. So all of that really means that the design of the fund is based on responding to community needs, rather than kind of designing a fund and then going into the community and trying to find opportunities that fits the fund, right? So that's, I guess, has been our approach and how we landed there. And again, my point earlier in terms of complementing what's already there, we know there's a lot of really good social enterprises out there that are providing good services, but they're looking for infrastructure that allows them to provide those services in the community. And that infrastructure needs to be aligned with their mission, so to speak, right? And so we think that, being able to provide that will complement some of the work that's being done by others in the market as well. So that's, I guess, has been our approach, and part of the drivers for that for us as well is that we want to bring in institutional investors as well along this, and those investors are not kind of adventurous, so to speak, in terms of the kind of risk they want to take on. So we felt that bringing a product to market where we are being intentional about the impact we're having, but also being intentional about managing risk and would be attractive to those kind of investors as an entry point. So that's, I guess, how we are thinking about the Tipunahapari Fund and how we can be, I guess, complementary and add value to the market in New Zealand.
Cool. Thank you.
That point about blended I'll just jump in quickly. That point about blended finance is a very, very important point, and it's something that's relevant for every one of the funds tonight. Just how important philanthropic funding, concessionary debt funding, government funding, as well as our own funding can be in actually getting projects away, where if we were the only ones funding it, we might not have enough capital, or the risks might be too high. So it really is a community response, oftentimes an ecosystem response to actually getting deals away.
Yeah. And for those who may be in the audience, we're going to look at these issues a bit more next week as well. We're looking at the social housing bond with the Salvation Army that has participation of philanthropic sector, working with community finance, but also the KiwiSaver funding through Generate. So that's an interesting example and it comes back to your point, Simba, in an era of term deposits kind of paying less than 1% and bond rates being so low, that actually if you're able to bring the risks down, then the expected returns become far more modest in terms of funding. Just to say thanks for that, Simba, and just to recognise Dennis Turton, who's in the audience of this Zoom call for all the hard work you put into making this happen for Tipunahapari. Dennis, it's terrific. Rowan, oh, sorry, before we do that, for those of you in the audience, if you're on Zoom, please put some comments, questions in Zoom chat. Otherwise, we'll keep on talking about what we want to talk about. And anyone on Facebook, and now we are streaming on Facebook Live and have been for most of the last half hour. You can put any comments or questions in the comments section, and my colleague's going to send them through to us here. So let fly with those questions. Rowan, what occurs to you out of this chat? Are you kind of optimistic given the experience of Green Finance Limited, the government's climate fund, which has perhaps could be characterised as having a fairly slow start? Are there opportunities available?
Yes, Barry, I heard James Shaw's comments on that on your seminar. Was that 1 week ago or 2 weeks ago? I think that was very pertinent. We think that a climate fund, and indeed some of the other folk who are on this call, would be ideal partners for the Green Investment Fund. And it would probably be good if it were a little larger and could move a little faster. But that's government for you, so I'm keen not to be waiting too much for that. I would emphatically agree with both Simba and Bill with the need for a blended finance type of approach, because what we've been seeing as we've been sort of looking at potential projects and potential investments for a climate VC fund is that they're all very different, and that reflects their sectoral differences. It reflects regulatory and policy challenges, different levels of kind of environmental externalities that can be different in different sectors. It's very hard to just vanilla template something and say this is going to work for everybody. And so having the ability to bring in government, to bring in maybe philanthropists or local landowners in some cases, and definitely industry, that's really important. Thank you.
Yeah, that's a really interesting one about Green Finance Limited. So in a way, if they are to play a catalytic role, they could be coming in as a partner and perhaps de-risking for you and others to invest and to leverage in more funding, right?
Yeah, that certainly could be, but I mean, just further to that, I mean, I've actually just spent today working on a predator-free project, which is involving the sensor company that they've invested in. So we are working right now. This is quite different from the climate fund, by the way. Just working to test out that model. So because their mandate is much broader than climate, in that case, we would not be a great partner for them. But I think the fact that climate is so large, I just keep saying this, the risk is large, the size of the prize is large, the cost to the economy is large. So it's probably going to need a lot of money from government, and it's getting quite a bit already. But you can see how especially on the infrastructural side, I mean, the Green Investment Fund with $100 million to play with, that doesn't get very far if you're looking at infrastructure, and there are big infrastructure risks for New Zealand from climate change.
So I should point out to listeners that each of these funds are wholesale funds, so they're available to those who qualify as professional investors or wholesale investors, and unfortunately they're not available yet to retail investors. So it's kind of a health warning if you're going out and looking to say, how can I put some discretionary funding into these great organizations? At the moment you can't. But a question for each of you: How do you see this kind of impact investment ecosystem developing over time? Do you see it developing into retail investment opportunities in future? How do you see? Do you see, for example, the time you go back to market, Roy? Do you see that you're going to be able to scale up the fund significantly, or will you kind of retain a fairly niche position? For each of you, what does your experience show you? for the future of impact investing in New Zealand?
And I think personally, we're speaking on behalf of the Impact Fund. I think our dream would really be when we come back to the market for a follow-on fund, to bring in retail investors through KiwiSaver schemes. That would be the dream. KiwiSaver schemes are, for the time being, obviously very slow to take liquidity risk, to invest in funds of our nature, but certainly many of them now are getting to a scale where they should be prepared to take the plunge. They are long-term by nature, as are we. And I think that's probably at this stage of the evolution of the sector, the right way for retail investors to be able to access these types of investments with not just one, but actually two layers of professional investment and protection for them, really.
Although, just to come back at you on that, Roy, that would be perhaps characterized as a little bit of impact investment in a much larger fund. And maybe that wouldn't suit all retail investors. Is there a place for a fully impact investment fund that is available to retail?
Oh, I certainly think there's a place for it in the market. Absolutely. It is very challenging to deliver, because obviously you need scale to make that work, quite considerable scale. And then for those retail investors, you've got to be able to deliver. You've got to be able to protect their money and deliver. So it's challenging, and I think the time will come where that is more feasible. When the market is more mature, and I'm talking about the number and quality of impact investments that are in the market. So I think that day will come. I'm not sure that we are there yet.
Simba, can you paint? Oh, sorry, Bill, carry on.
Yeah, it's as a known critic of equity crowdfunding, I guess I should weigh in here a little bit. So equity crowdfunding in New Zealand started out and was totally focused on investing in the riskiest part of the marketplace, which is early stage investing, and so I've been critical of that, because I don't feel for retail investors that they really understand the risks that are involved there, and if they don't in the angel space, if they don't have the benefit of the processes that angel investors go through, they are in some cases almost being thrown to the wolves. So I don't think that's a very healthy environment. But on the other hand, I know that there are many younger people who absolutely want to put some money to work in this space. And so we have to find ways to make that work. Obviously overseas, there's all kinds of listed products that they can invest in. We have to develop that part of the environment here in New Zealand so that retail investors can invest through their brokers into listed things that have got appropriate risk levels for them. And similarly, we have to find a way, and that's for us here on this panel and those that come behind us, to be able to create products that can deliver the risk and returns that the retail investor would be looking for. We have to be careful about walking them into high risk areas, I think.
That's a really interesting point about crowdfunding being the high risk area, because of course it's the lowest compliance and the least regulated. So you're right, it doesn't have the protection that most angel investing groups have. So it's a really good point. Simba, how does it look in terms of the Australian ecosystem, and what can we kind of gain from insights as to what's happened in Australia?
I think the Australian market has also struggled in creating a retail product that's viable for reasons already mentioned by others, that you need scale, liquidity is an issue, and so since the most impactful stuff are not necessarily the most liquid opportunities, we have seen kind of impact products in the listed space, which is sort of probably kind of ESG plus rather than kind of measurable and demonstrable impact. And I think that's a good starting point, and it's okay there, right? It's not. I think the key thing there is to empower the individual investor. In our view, I guess if we talk about long-term dream, we want to empower the individual investor to have a say around how we can transform capital for good. And as things stands, as an individual investor, there's limited options to kind of vote with your money, right? Because your pension fund is not necessarily providing you with that opportunity most of the time. There's no easily accessible products for that. So I think in terms of developing the market, that's where we want to, because then that empowers people to air their views. Because as we stand, you know, a lot of people care about climate change, for example, as Rowan said, but there's not a lot of climate change products, which is a bit of, you know, a disconnect, right? So we want to make sure that connect is there. And that's our view. And I guess our hope for the New Zealand market is that, you know, we can start to create opportunities where, retail investors can invest with a reasonable risk return profile. And so the things that the way we've designed our fund, for example, is it's low risk to some extent, but it is low liquidity, which is essential for retail. We're not there yet, and it's going to be hard for us. It's still a puzzle we need to kind of put together around how do we solve the liquidity issue and alongside the low risk. So anyway, I'm rambling a little bit, but we would welcome the opportunity to democratize the impact investment space and empower individual investors to vote with their money and really express their values through their investment. But it's going to take time to get there, because it is a hard nut to crack to provide, you know, viable retail products.
So really agree with that. You know, the approach of Mindful Money is taken is that we need to start where people are and basically help them along a spectrum towards impact. And there's going to be a lot of ESG and exclusions and other ways that they can limit the harm from their investment, maybe towards inclusion of some impact investments in their portfolios in future as the funds start to offer them. And then maybe in future there will be some of these retail offerings available. But it's important, really, as you say, to kind of help empower people along that pathway and understand the nature of what they're investing.
Yep.
And we really are still very early in New Zealand. Purpose Capital is still raising capital, and we have a very wide database, as you can imagine, given that we're owned by Enterprise Angels, which is a not-for-profit incorporated society. And through that database and making the opportunity available, we're still very early. There's not many people that we would be in touch with that wouldn't have the financial ability to participate, but a relatively small percentage actually do. So we've got a ways to go for sure in the marketplace. Yeah.
It's interesting, isn't it, Bill? I have the suspicion that a lot more people would qualify under wholesale or professional investors than actually realize that they qualify. So there may be more of a potential kind of investor pool out there than maybe is apparent. But anyway, I haven't got the data on it.
Yeah, that's a good point, Barry. And I think in particular for Rowan's fund, you don't have to qualify simply through having $5 million. You can qualify through expertise as well. And in specific areas of expertise, Rowan may find that he can get people qualified because of their expertise. Yeah.
So, Rowan, final word to you. We're probably going to have to wrap up fairly soon, but lead us out.
Yeah, thank you, Barry, and thanks for that suggestion, Bill. That's really valuable. I would guess this space has got quite a long way to go. It's got a lot of further growth. I read the Responsible Investment Association's report on impact investment that came out a month or two ago. Like probably most of you, that showed that if you look at a pure assets under management measure, then impact investment in New Zealand is absolutely booming. That's good news. On the other hand, a lot of it's green bonds, which I would say is probably at the more conservative end of things, and often doesn't have the additionality that I'm really looking for with the Climate VC Fund. We really do want to see investment in products and services that are going to push along emissions reduction, not just refinance someone's existing wind farm. So I think it's great that we have more options available to us, like some of the good folk on this call, and I think there'll probably be more to come, and that will help us to sort of parse that whole space rather than saying it's a green bond, so that's green enough for me. I think that will be good for some people, and it might be good for some parts of people's portfolios, but there'll be other groups of people who perhaps will want to talk to others on this call, and maybe myself too. So thanks for the time.
Thank you, Ronan, and thank you to all. That was really interesting. I really enjoyed that, and more power to you all for success in your impact funds. And I think I certainly hope the audience, both now and through the video recording, will kind of support and follow what you're doing, support as they can. Just to close for everyone, recordings of this and all the other Mindful Money seminars in the series are on the events page of our website. Our website's www.mindfulmoney.nz. Thank you for joining. Do come back next week because, as I said, we've got the anatomy of that social housing bond, which was put together in order to finance Salvation Army's social housing development, project managed by Community Finance, and included the participation of finance from Generate KiwiSaver. So we're having Salvation Army, Generate KiwiSaver, and Community Finance representatives on the call next week, so it should be a really interesting one. So please come back. Thanks all of our sponsors. We have support for these seminars. Thanks especially to Booster Asset Management, Generate Investment Management, Harbour Asset Management, and to Sustainalytics. Thanks for joining us. Have a good evening. Ka kite anō.
Thanks, Barry.
All right. Thanks, everyone.
Thanks very much, Barry, and thank you all.
Everybody.
Cheers all.